This week, 3 ways to consolidate debt in retirement. More after this short message.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. Retirement is often a catalyst for exposing long-hidden financial weaknesses. A retiree's income, cash flow, and monthly debt obligations contribute either to their sense of financial well-being or unrelenting stress. The challenge is to effectively engage with the older homeowner, but most importantly, to understand their financial challenges and bring a solution instead of a product to the table. Benjamin Franklin said, "Prospecting is finding the man with the problem." And there are certainly plenty of problems in retirement out there. Chief among them is credit card debt. Today, credit card interest rates average between 24 to 28%. Consequently, many retirees find themselves making just the minimum payment for what is essentially the remainder of their lives. Now, in 2024, the average credit card balance for Americans 62 and older is $6,600, that's baby boomers, and $3,400 for the silent generation. Recent research from MarketWatch found that older adults aged 65 to 74 carry an average of $135,000 in debt, while those 75 and older have an average outstanding balance of $95,000. In 2020, outstanding medical bills accounted for an average of $13,800 in medical debt for Americans over 65. Not surprisingly, many retirees are looking for solutions to help ease the burden of monthly payments. So today we're going to examine 3 common ways that older Americans could potentially find relief from their debts. And the first is a debt consolidation loan. Next is a debt settlement. And third, a reverse mortgage. But before we jump in, I want to thank you for watching and ask you to consider subscribing to this channel. That way you never miss a future episode. Also, a disclosure for anyone that's watching that's not a reverse mortgage professional, perhaps you're a homeowner, I am not a financial advisor. I am a reverse mortgage commentator, trainer, and also a passionate supporter of the proper uses of reverse mortgages in retirement income planning. So always seek the advice of a trusted financial professional when considering a reverse mortgage. So let's look at one of the common options that debt-burdened older homeowners may consider, and that is a debt consolidation loan, which has a couple of unique advantages. First, several monthly payments can be combined into one loan, and that is easier to manage. It simplifies the process. Second, consolidation loans typically have lower interest rates than credit cards, and in some cases, lower interest rates than personal loans. Business Insider reports that today's average debt consolidation interest rate is anywhere from 12 to 18%. The loan repayment periods range anywhere from 1 to 7 years. Today, HELOCs or home equity lines of credit and also personal bank loans are being used in lieu of formal debt consolidation loans, so there is some flexibility there. The next option is debt settlement. Debt settlement programs help an individual reduce their debt by negotiating with creditors to accept a lower payoff amount than the full balance that is owed. But the process is a little tricky and it works basically like this. After an initial assessment by the settlement company representative and then approval, clients are typically asked to make regular deposits into a dedicated savings account instead of paying their creditors directly. Now, of course, the risky part is during this time when the clients stop making payments, they have penalties and interest that are accruing, but then they're also taking a reduction of their credit score. Now, once a predetermined balance has been reached, then the savings account can be tapped to be used to pay off these creditors based on the reduced amount that's been agreed upon. The debt settlement process can take anywhere from 24 to 48 months to complete, and during that time, a client could face potential legal action from a creditor who is unwilling to wait for a settlement. And most importantly, and yet most often overlooked, is the fact that any amount of debt that is forgiven could be counted as taxable income, which could leave them with a surprise tax bill and another installment payment, this time to the IRS or state taxing authority. If there's any strategy that should be considered an option of last resort, It's a debt settlement. And all this brings us to the third option, a reverse mortgage. I'll openly admit that I believe that reverse mortgages are not only legitimate, but they're generally misunderstood and mischaracterized. But they're also being overlooked, and in many cases to the detriment of the retiree. Today's typical reverse mortgage interest rate is about 7.5%, and that's well below personal or consolidation loans that are charging anywhere from 12 to 18%. Unlike debt settlements, a reverse mortgage doesn't damage a retiree's credit score, nor does it expose them to civil legal actions filed against them by their creditors or lead to an unexpected tax bill for a forgiven debt. However, the biggest advantage for retirees that choose to use a reverse mortgage is that you're consolidating debt or converting debt into a loan that doesn't require payments, boosting cash flow. Now, there's no monthly principal or interest payments required, and that is a plus for retirees. Reverse mortgage borrowers can choose to make a full or partial payment if they want, or no payment at all, as long as they continue to meet the obligations of the loan and stay current on their property taxes and their homeowner's insurance premiums. In addition, unlike a HELOC, any available loan proceeds in an FHA HECM reverse mortgage line of credit cannot be frozen or reduced simply due to a change in household income or house values. And even better, the unused portion line of credit in a HECM is increasing modestly each month. Now, debt consolidation loans and debt settlements have benefits, but also significant pitfalls, which we've enumerated. Even reverse mortgages have their own risk, and chief among them is that the homeowner's underlying behavior that led to the accumulation of excessive debt in the first place. Now, the psychology of debt and spending is another topic that we will be covering in a future episode. In the meantime, keep these 3 common ways that homeowners may consolidate or convert their debt when you're meeting with someone that may be really struggling with monthly payments and maybe considering a consolidation or settlement. That's it for this week. Be sure to share this video if you would on your LinkedIn networks. And as I mentioned earlier, we have a YouTube channel. Be sure to subscribe and hit the notification bell. And each and every week, we bring you the most recent reverse mortgage related news for you, the mortgage professional, on our weekly podcast, HECM World Weekly. We have both an audio and a video edition, which you can find here. And the audio edition is also on Apple Music, Spotify, and Podbean. Thank you for watching and have a great week. And be sure to return next Monday for more reverse mortgage news, commentary, and analysis you'll only find here at HECM World.